Let me say this clearly. If you don't master your psychology in trading, you will stay broke, not because the market is unfair, not because your strategy is bad, but because your mind will sabotage you. Most traders spend years trying to master charts. They memorize patterns. They test indicators. They jump from system to system, but they never train the one thing that actually controls every decision they make: their psychology. Psychology is what determines whether you execute your strategy properly. You can have a profitable system on paper. You can understand risk management. You can know exactly where your stop should be. But if your emotions take over at the moment of execution, none of that knowledge matters. That's where most traders fail. They don't lose because they don't know what to do. They lose because they don't know what to do. They lose because they don't do what they know. There are three psychological weaknesses that quietly destroy accounts: fear, ego, and impatience. Fear shows up when you hesitate to take valid setups. You see your pattern, it meets your criteria, but you second guess it. You reduce size, or worse, you skip it completely. Later, the trade runs perfectly without you. Now you feel regret. Regret turns into frustration. Frustration turns into forced trades. Forced trades turn into losses. One moment of fear creates a chain reaction. Ego is more subtle. Ego doesn't want to be wrong. So when price moves against you, instead of accepting the loss, you adjust the stop. You widen it slightly. You justify the decision. You tell yourself the market will come back. Sometimes it does, and that reinforces bad behavior. But when it doesn't, the loss becomes larger than it needed to be. Ego turns small losses into large ones. Impatience is the third killer. You don't want steady growth. You want fast growth. You want to scale quickly. You want bigger numbers. So you increase risk prematurely. You trade more frequently. You take lower quality setups. And you justify it by saying you're being aggressive. But aggression without discipline is self-destruction. Mastering trading psychology means controlling these three forces consistently. It doesn't mean you won't feel fear. It means you act correctly despite fear. It doesn't mean you won't feel ego. It means you cut losses anyway. It doesn't mean you won't feel impatient. It means you wait for your edge. Professional traders understand something most retail traders never accept. Your strategy gives you a statistical edge. Your psychology determines whether you realize that edge. If you violate your risk rules during a drawdown, you distort your results. If you size up emotionally, you distort your results. If you size up emotionally, you distort your results. Distorted execution, destroyed profitability disappears. You cannot separate psychology from profit. They are directly connected. Now let's talk about identity. If your self-worth is tied to your last trade, you will never be stable. On a green day, you feel confident. On a red day, you feel insecure. That emotional swing creates instability. Instability leads to inconsistency, and inconsistency keeps you broke. Serious traders detach identity from outcomes. They judge themselves based on execution quality, not profit. Profit is an outcome. Execution is controllable. If you execute correctly over time, profit follows. But if you judge yourself based on short-term results, your emotions will constantly fluctuate, and fluctuating emotions lead to fluctuating behavior. Trading amplifies who you are. If you're impulsive in life, you'll be impulsive in trading. If you avoid discomfort, you'll avoid taking losses. If you seek validation, you'll chase big wins to feel important. The market exposes character weaknesses, that's why. Psychology is not optional. It's foundational. Mastering trading psychology means building emotional discipline before scaling capital. If you cannot follow rules with small size, you will not follow them with large size. Money magnifies behavior. If you are reckless at $1,000 risk, you'll be destructive at $10,000 risk. Psychological weakness does not disappear as you grow. It grows with you. That's why you must fix it first. Now let's talk about how to actually build trading psychology like a professional. Because awareness alone changes nothing. You can understand fear, ego, and impatience perfectly and still blow up an account if you don't train discipline deliberately. Psychology in trading is not something you figure out over time. It's something you structure, and structure is what separates amateurs from professionals. The first step is building mechanical risk rules. If your risk changes based on how you feel, Your psychology will never stabilize. Professional traders decide their risk before the trade, not during it. That means a fixed percentage per trade, fixed maximum daily loss, fixed weekly exposure. No negotiation. The moment you start negotiating with your rules, you hand control back to emotion. Emotion under pressure is unpredictable, and unpredictability destroys consistency. If you know you only risk 1% per trade, every loss becomes manageable. Manageable losses reduce fear. Reduced fear improves execution. Improved execution protects expectancy. Expectancy builds profit. Before the market opens, you must already know what setup you're trading, what invalidates it, what confirms it, where your stop goes, and where your target sits. If you wait to decide during volatility, emotion will influence you. Pre-commitment removes debate. Debate invites emotion. Emotion invites mistakes. The third step is stopping discipline. Most traders don't blow up because of one trade. They blow up because they refuse to stop. After 2 or 3 losses, frustration builds, the urge to recover increases. You start trading to fix damage instead of trading your edge. That's when accounts collapse. If you hit your daily max loss, you stop, no discussion. If you hit your profit target, you stop. Overconfidence can be just as dangerous as fear. Stopping rules protect you from yourself. Now let's talk about psychological journaling. After every session, ask yourself, did I follow my rules? Did I hesitate? Did I move a stop? Did I force a trade? Did I increase size emotionally? Write it down. Patterns will appear. Maybe you overtrade after wins. Maybe you hesitate after losses. Self-awareness creates correction. Without tracking your behavior, you will repeat mistakes unconsciously. Next is emotional control during live trades. You cannot eliminate emotion, but you can reduce its authority. Slow down execution. When your setup appears, pause. Confirm your checklists. Say your risk aloud if necessary. That pause creates separation between impulse and action. Another tool is detaching from P&L during the session. If you constantly stare at your profit and loss, your emotions fluctuate. Professionals focus on price structure, not account balance. Now let's talk about confidence. Emotional confidence comes from recent wins. It's fragile. One loss can destroy it. Statistical confidence comes from long-term data. It survives drawdowns and bad weeks. To build statistical confidence, you must know your numbers: win rate, average R multiple, maximum historical drawdown, expectancy. When you understand these deeply, you stop reacting to normal fluctuations. Clarity creates calm. Calm execution builds stability. Stability builds growth. Identity shift is critical if you see yourself as someone trying to make money. Fast, your behavior reflects urgency. If you see yourself as a risk manager, your behavior changes. Risk managers survive. Survivors compound. Compounding creates wealth. Do not increase size because you feel ready. Increase size because your data supports it, because your execution has remained stable for months. Scale only when psychology proves stable. Mastering trading psychology is not about eliminating mistakes. It's about reducing their frequency and size. It's about maintaining discipline when emotions spike. Now let's connect psychology directly to wealth building. Most traders think psychology is about feeling calm. It's not. It's about staying profitable long enough to build real wealth. What keeps traders broke isn't the wrong strategy. It's unstable behavior. Unstable behavior creates unstable returns. Unstable returns prevent compounding. Without compounding, you stay stuck. Compounding only works when volatility in your behavior is controlled. Not market volatility in your behavior is controlled. Not market volatility, but behavior volatility. If 1 month you follow your system perfectly, and the next month you revenge trade and over-risk, your long-term growth collapses. Compounding demands consistency. Consistency demands discipline. Discipline, the market doesn't care how smart you are. If 2 traders use the same strategy, the one with better emotional control will outperform long-term. Not because the system is different, but because execution is different. When your account grows, emotional pressure increases. The numbers get bigger, the swings feel heavier. If your psychology is weak, bigger size will expose it instantly. Money magnifies psychology. It doesn't fix it. Psychological mastery means taking every valid setup without hesitation, cutting losses instantly without debate, never moving stops emotionally, never increasing size impulsively, stopping when limits are high, operating the same way on green and red days. That's mastery. Not perfection, but stability. Wealth in trading isn't built on emotional spikes. It's built on structured repetition. Repetition creates data. Data builds confidence. Confidence creates scale. Scale creates income. You are your biggest risk, not the market. Your reactions, impulses, emotional decisions. That's the real risk. Professional traders obsess over process more than outcome. They measure rule-following percentage. They track execution accuracy because discipline consistency determines income consistency. If you want to stop being broke, stop focusing on what the market owes you. Start focusing on what you owe your process. Discipline, consistency, patience. Trading psychology isn't about staying calm. It's about becoming disciplined enough to deserve growth. The market rewards stability, and stability is psychological. You are not competing against other traders. You are competing against your impulses. Your urge to recover quickly. Your urge to prove something. If you cannot control those impulses, the market will expose you repeatedly. Real wealth in trading is boring. It comes from steady performance repeated over time. That requires emotional endurance. Accept losses without revenge. Accept slow months without frustration. Accept slowdowns without system hopping. There are only two types of traders: those who control themselves and those controlled by emotion. The second group stays stuck. The first group compounds. You don't need to be fearless. You need to be disciplined. You don't need to eliminate emotion. You need to override it. You don't need to trade more. You need to trade more. You need to trade correctly over and over again. Psychology is the gatekeeper to wealth in trading. If you master it, you build something sustainable. If you ignore it, you repeat cycles. Short-term gains, long-term frustration. The market doesn't decide whether you stay broke. Your reactions do. Every impulse you override strengthens discipline. Every rule you follow builds stability. Over time, those controlled decisions build real money. Master your mind. Control your risk. Protect your structure. Execute without ego. Stop negotiating with your rules. Because in trading, the real edge isn't strategy. It's psychological control. And once you own that, the market stops feeling like chaos. It starts feeling like opportunity. That's the difference. That's the shift. Master trading psychology or stay broke. Let's end this the right way, because this is where most traders misunderstand everything. They think trading psychology is about staying calm. It's not. It's about becoming disciplined enough to deserve growth. The market does not reward effort. It rewards stability, and stability is psychological. You don't stay broke because you lack information. You stay broke because your behavior is inconsistent, and inconsistent behavior cannot compound. That's the real reason most traders never scale. They have moments of brilliance, a great week, a strong month, a perfect streak, and then they break their rules. They increase size too fast. They trade outside their system. They get emotional. They undo months of progress in days. That's not a strategy problem. That's a psychology problem. Here's something you need to understand deeply. You are not competing against other traders. You are competing against your impulses, your urge to recover quickly, your urge to feel smart, your urge to prove something, your urge to rush. If you cannot control those impulses, the market will expose you repeatedly. Psychological mastery is not about motivation. It's about structure. Structure removes emotional decision-making. Structure forces discipline when emotion rises. Structure keeps you stable when volatility. Why increases? Most traders trade based on how they feel. Professionals trade based on predefined rules. And that difference separates broke traders from consistent ones. Let's talk about long-term wealth. Real wealth in trading is boring. It doesn't look dramatic. It doesn't come from one explosive year. It comes from steady performance repeated over time. That requires emotional endurance. You must be able to accept losses without revenge, accept slow months without frustration, accept drawdowns without system hopping. That's psychological maturity. Maturity is profitable. Immaturity is expensive. If your emotions swing wildly, your account will too. If your decisions fluctuate based on recent outcomes, your equity curve will fluctuate too. Your account is a reflection of your internal stability. If you want to grow your account, grow your discipline. Let's simplify this completely. There are only two types of traders, those who control themselves and those who are controlled by emotion. The second group stays stuck. They blame the market, they blame volatility, they blame manipulation. But the market is neutral. It simply reflects behavior. The first group takes responsibility. They track their mistakes, they refine their rules, they protect their capital. They don't chase, they don't overreact, they operate calmly. And calm execution compounds. Here's the part nobody wants to hear. You can have the best strategy in the world. If your psychology is weak, you will never realize its potential. Execution is what turns theory into profit. And execution is a psychological test. Will you follow your plan? Will you accept risk? Will you respect your stop? Will you walk away when limits are hit? That's the real challenge. Not predicting the market, controlling yourself. Once you truly understand that, everything changes. You stop obsessing over new systems. You stop looking for magic indicators. You start refining behavior. You start tracking discipline. You start tracking discipline. You start protecting consistency. And that's when progress becomes real. Because once your execution stabilizes, your growth stabilizes. And stable growth scales. Let's be clear. You don't need to be fearless. You need to be disciplined. You don't need to eliminate emotion. You need to override it. You don't need to trade more. You need to trade correctly, over and over again. Psychology is the gatekeeper to wealth in trading. If you master it, you build something sustainable. If you ignore it, you repeat cycles. Short-term gains, long-term frustration, temporary confidence, permanent inconsistency. So the question isn't whether psychology matters. It's whether you're willing to train it. Because mastering trading psychology requires effort outside the charts. It requires journaling, self-reflection, honest review, rule enforcement, patience, accountability. That's not glamorous, but it's powerful, and here's the final truth. The market doesn't decide whether you stay broke. Your reactions do. Every impulse you override strengthens discipline. Every rule you follow builds stability. Every controlled decision compounds quietly. And, over time, those controlled decisions build real money. Master your mind. Control your risk. Protect your structure. Execute without ego. Stop negotiating with your rules. Do that consistently and you won't stay broke. Because in trading, the real edge isn't strategy. It's psychological control. And once you own that, the market stops feeling like chaos. It starts feeling like opportunity. That's the difference. That's the shift. Master trading psychology or stay broke.